Okay, so in this lesson, the last on the unit on consumerism, we're going to talk about debt. We'll begin by looking at credit and installment debt. So when we talk about credit and installment debt, we're talking about the purchase of goods through credit. So basically, we are buying stuff with money that we don't actually have in pocket and plan on paying back later. So the primary problem here is that the amounts placed on credit cards, it's not paid back immediately. One of the things that we see within the United States is that we have this mounting credit card debt because we're not paying them off immediately, and as a result of that, of course, we're seeing the interest rates on them. So this creates two issues. So one, debt builds, what we call the principal, which is what you pay. So interest is charged to the principal. So if that principal doesn't come down, then the amount of interest being charged, while that interest rate stays the same, the amount of money that the interest is generating is just building. So for example, if you charge $1,000 on a credit card, you can choose to pay it off and then you pay no interest, or you pay a portion of it. Well, whatever that portion you pay, whatever remains is what you're paying interest on. So when we pay it off, we have no interest. We pay a portion. Let's say we pay $600. So we still owe $400, plus we are charged interest on the $400 and must pay that as well. Some of these credit card companies have interest rates. I mean, we're talking in 20% range. I mean, so they're pretty high. So some companies you'll see here charge 24% interest on the remaining balance. So let's look at that. So 400 times 0.24 equals 96. So even if we don't use the credit card next month, we would still owe $496. That is how credit debt gets built up. So when you look at this map here, so this is the average credit card debt. So now remember, this is just on a credit card, nothing else. We're talking just credit card. So you'll see here, Alaska held the highest debt by the end of the first quarter of 2010, averaging $7,135 per person. This puts it almost 30% over the national average. Notice the two highest states are Tennessee and Alaska. So what we see, of course, is within our state and also within Alaska, and of course in the southern states, we see heavy credit card debt. In other words, we're talking about an average in Tennessee of people owing between $6,500 and $7,500 on a credit card. That's just a credit card. That doesn't count any other credits or anything. That's just the credit card. That doesn't count a mortgage, car payments, or anything. Now, when we compare that to this map down here, so this is a median household income. So we can see here when we're looking at it, the darker colors represent higher incomes, the lighter colors represent lower incomes. Tennessee, for example, is in the 40,000 to 49,000 range. So you want to think about it like this. We can just cut it in the middle and say the average person in Tennessee makes about $45,000 a year and owes about $7,000 on a credit card. So, I mean, there's a lot of the income here being generated is going into paying for that credit card and paying for that debt and the insurance on that, not insurance, but interest on those credit cards. Okay, now this map's a little different. It says the state of U.S. debt. So this map, though, covers all debt. So when we look down here, average debt includes credit cards, auto loans, personal loans, student loans, but not mortgages. The reason why it doesn't include mortgages is because one of the things about mortgages is we're paying those mortgages is we're actually generating value in our houses. Typically when we buy a house, by the time we sell it, it's actually worth more. So we're talking about all types of debt. So now we start looking at it and see where are these areas that have the most debt. Notice Tennessee is kind of in this 26 to 26.9 range here. You know, we're in this range here, but if you'll notice some of the other southern states are in some darker areas. Texas, Louisiana, Oklahoma, even up here in Virginia, I mean, they're in this range right here, this $30,000 range. You see Dallas, Fort Worth, $30,000, Houston, $29,600. In other words, these metropolitan areas, they have significant debt. People living there have significant debt living there, which tells me that it's too expensive for them to live in. And so that's one of the things you have to look at. Is it? I mean, basically, in this case, you would say people are living beyond their means. Okay, so in that last slide, one of the things we looked at was the amount of money that it costs to people to live in these larger cities, and the fact that it's they're living beyond their means, and that's kind of what we want to look at next. So, what is easy to figure out is that on average, Americans are spending more than they're making. So, on average, people spend more money than they make. That's what's creating the debt. Of course, nowhere is that higher than in the American South. So let's look at this consumer debt breakdown. So you'll notice here consumer debt breakdown as of August 2010, that's 2.4 trillion. Okay, so that's in the trillions. So we have 2.4 trillion in debt. Now of that, 822 is revolving debt. Non-revolving debt is that 1.6 billion. So that's a huge portion of it. So credit card debt, like we just looked at, is called revolving debt. It changes on a monthly basis. So when we look at this revolving debt down here, this 822 number, that is a number that changes on a monthly basis depending on what people are paying and how much they're paying off. So it's that lighter colored purple in this circle. So this would mean that in August of 2010, Americans owed $822.4 billion in credit payments. Now think about that. That's 1 month. And we'll come back to this 1.6 billion number here shortly, but we want to look at that revolving debt first. So not all debt is caused by credit cards. Installment debt is money owed from the acquisition of loans from banks. We're still charged interest on this debt, but at a far lower rate. So when we talk about paying a mortgage, I mean, that's an installment debt. If you bought a car and you're paying off a car, that's an installment debt. It's a set amount of money you pay each month. So we're still charged interest on this debt, but it's a far lower rate at 3 to 4%. So borrowing money from the bank is actually far better prospect than putting something of a large purchase on a credit card because of the difference in the interest rates. So this amount of debt is structured into evenly divided monthly payments over a set amount of time. So we're talking loan, car payments, mortgages. All of these are in types of installment debt in which we pay the same amount each month, and the interest rates on these are very low. So the longer the lifespan of the loan, the greater the amount of interest that will be paid. So when you're talking about a house, there's a massive, massive difference between a 30-year mortgage and a 15-year mortgage. Just like there's a massive difference between paying 3 years or 5 years on a car, because the longer amount of time you pay on it, the greater the amount of interest you're going to end up paying overall. Okay. Now, when we looked at that graphic a second ago, we had two types of debt. We had revolving and we had non-revolving. A non-revolving debt was essentially double what the revolving debt was. So the non-revolving debt on our graphic is in the dark purple. And this is debt that does not change monthly. So when you look at that 1.6 billion, it's not being changed in a monthly installment. So why does that make this important? First, the good. So borrowing money puts into the economy. Think Phillips curve. So when we're talking about installment debt, we're talking about mortgages and car payments. That's the borrowing of money. So the interest rates on those are lower, but the interest money that we pay on those is money that's being generated into the economy. It does create inflation. Banks create inflation throughout the loan process and also through the interest rate process. But like we said, that's good because that continues to put cash into the economy and creating jobs through this, like we said, this Phillips curve theory. So home buying as an example of this. The bad, on the other hand, though, borrowing can be dangerous if funds cannot be paid back. So this is more of an individual or a geographic area, a regional place. Basically, we can kind of look at the housing market around 2008. You can kind of think about it from the standpoint of, let's say a lot of people are buying homes, and they're buying homes that they can't exactly afford to pay for. And so what happens is they borrow huge sums of money, $100,000, $200,000 to pay for houses, and they can't pay it off. Well, basically, they're not able to pay that loan off, and that the bank takes over the house, and then the job of the bank is essentially to sell that house for as much as they can get for it in order to pay parts of that loan. And this becomes dangerous because if all of these people are borrowing money and nobody's paying it back, well, we're not generating any money in the economy. Plus, the people who invested their money in the banks to be borrowed, well, now that's something they aren't gaining access to. They have insurance on that debt, but on the loans, but only to a certain extent. And what you put in that bank is only going to be covered up to a certain amount. So the money must come from somewhere, or the economy can collapse. So literally, when what we call this a little bubble, in that case, it was a housing bubble, in which banks were probably loaning out large sums of money to people who they actually knew couldn't pay it off. And what's happening is all these people are buying this stuff, and so this bubble gets created of people basically living beyond their means. And when that bubble pops and the housing comes down, well, then we see, of course, significant amounts of money basically leaving the economy. It creates deflation, and of course, when deflation occurs, one thing about Phillips' curve is inflation creates unemployment. So therefore, deflation would create a serious issue, because we're taking money out of the economy. If inflation is going to create jobs, well, deflation is going to get rid of jobs. So that home buying as an example of that is a case in which we actually saw this happening in the last 2 decades, where we saw people buying homes with loans that they simply could never afford to pay back. Okay, so this is in no way going to be 100% in terms of detail. It's a generalized version of U.S. economic collapse based on what we said with that housing market. So you have lots of people borrowing money to buy homes. Many borrow more than they can afford. From this perspective, what we're seeing is a housing market boom, with lots of new houses are being built. And so lots of jobs are being created on this housing boom. We see all these people going into construction and building homes. They're being paid fairly well, but the problem with that, of course, is that the people borrowing the money to actually build these homes, they're borrowing more than they can actually afford. You see these shows like Flip This House and all these different types of shows. Basically what happens is you had a whole lot of people who were borrowing money. They would then take that money, buy a house, they would fix it up, and then they would turn around and sell it for more money. This was, this Flip This House, and you had all kinds of shows in which you saw this taking place. Everybody was buying these rundown homes, fix them up, turn around and sell them. Well, that's great, except for what happens if you can't sell the house. Well, then you can't pay back that loan. And we call this speculation. And we've seen this throughout American history. We call it speculating, in this instance on the house market. But to give you an example, throughout the 1800s, we had several, not what they would call depressions, but rather what they would call panics. And a large portion of those panics were on speculation of the land. Speculation, basically, in the sense that they would buy this cheap land and then they would turn around and parcel it out and sell it for a higher price and pay off the loan and make a profit. Then they began to speculate on gold and the gold market. And so what they're doing essentially is they're borrowing large sums of money, and they're using that in order to try to generate even greater sums of money and make a profit. Well, the thing about this speculation within these markets is almost inevitably that the speculation of that market, it creates a bubble. It creates basically a fake value, and that eventually comes crashing down. So eventually the market slows, as does general spending. And so here's what we're seeing. So we have all these people borrowing all this money to speculate on the housing market. And so when the market slows, as does general spending, unemployment rises and loans begin to go unpaid. So people stop purchasing houses. This speculation, of course, these are people who start not paying loans back. And then how the banks, of course, are losing money. And speculation is a big part of this. It's something that's happened over time. It happens all the time. And you can think about it from the standpoint of looking at it and saying, okay, well, the value of this house, let's say it's $100,000. But because of the market they're in, these people will flip these houses and then sell this house for $130,000 when it's really only worth $100,000 to make $30,000 profit. So they pay the loan back and then they have their profit. Well, when the market starts to slow, none of these people are selling these houses. So they're just sitting on the market, and now all of a sudden they can't pay these loans back. The banks are losing money, and then that's creating more unemployment. Okay, within the market, there are different types of financial institutions which you can borrow money from. So you see these commercial banks, savings and loans, these different places. So most common place for people to get a loan from is a commercial bank. Regions Bank, all these different banks, Wilson Bank and Trust. People go in, borrow money. When they do that, of course, they pay them back, pay the interest, and we're good to go. But you see also these savings and loan associations, and they specialize in large loans like those for houses, and they have slightly lower interest rates. One of the reasons why they're able to drop their rates down a little is because the amounts of money they deal in overall will generate greater profits. We have savings banks. These are like the commercial banks, but they focus on being savings accounts. They do a lot of loan money. Basically, if you're putting money into a savings bank, it's not something you're planning on pulling out anytime soon. So then that generates large amounts of money for these banks to then loan out to people. Credit unions. These are established by employees to save and loan to specific groups. You see these with education. You see these with the military. So these different credit unions, and they work specifically with certain groups. Then we have finance companies. And what happens here, this is an interesting, so they buy loan agreements from companies and charge higher interest rates than others. An example would be like a Kohl's card. So think about it like this. This happens actually sometimes with houses and stuff too, is these companies will come in and they'll buy your mortgage from another institution. And when they do that, so they'll buy it and then they'll basically take over it. And so we see this a lot with these companies who specialize in nothing more than buying basically loan agreements from others. So when you take this Kohl's card, Kohl's actually, you know, if you look at Kohl's, Kohl's isn't a finance company, it's a clothing store, it's a market. But they have a Kohl's card. Well, that Kohl's card is owned by a finance company who's essentially running that agreement for them. Okay, so let's look at some of how this works. So here, when you want to borrow money, the lender will hire a credit bureau, and they determine your ability to pay back loans. That's your credit score. All that credit score does is basically the higher the number it is, it says the more likely it is that you're going to pay off any loans that you have. One of the interesting things that'll happen to you, and this happened to my wife and me when we first got married, is we didn't have any credit card debt and we never used them, and our credit score actually was not really good. And we actually had to get a credit card and purposely start putting stuff on it and paying it off just to generate a better credit score, because people were hesitant to give us loans because we didn't have any debt. We weren't paying anything off. So that score had to be driven up. So the credit bureau runs a credit card check to basically determine this. So the credit check is an investigation of your financial history and income. Basically, they want to know whether or not you're really going to pay this off. So the credit check allows the credit bureau to assign you a credit rating, which calculates the risk of you defaulting on your loan. So in addition to your credit rating, your capacity to pay, lenders may also consider the amount of collateral you have. And of course, collateral is your capital or personal wealth. So that leads them through the process of deciding yes or no whether they're going to loan you the money and what amount they're going to loan it to you. Because basically when they do loan it to you, really what they're focusing on is they want to know if you can pay it back or not. And if you can't, what can they take from you of value that may equal that loan? Okay, so let's talk about why debt is important. So debt is generated from loans. Obviously, people go into debt knowing that they're going to pay the debt off on purpose so they can buy stuff. So people are borrowing money. You know, this is our loans. Question, of course, is where does that money come from? Well, it comes from savings accounts. What happens is people will deposit money into savings accounts. Now, the banks understand that you're not all going to show up and try to withdraw all your money at the same time. So what the bank will do is the bank will set a percentage of those savings accounts in holding, and the rest of it they're going to loan out to people, and then the banks make their money off the interest from those loans. And so that's how that process operates. Now, the FDIC is the Federal Deposit Insurance Corporation. And this is an important group. It was established during the 1930s, during the Great Depression. And basically what its purpose is to ensure that the money that you put into savings is guaranteed. So they will insure it and they will repay it if the bank defaults. But it's only to certain amounts. Now, that's crucial, because the FDIC allows people to be comfortable with depositing money into their banks, and it allows for loans, which loans are important on the economic growth. Basically, we cannot generate economic growth without the loan system in place. That's one of those keys here that we have to look at within the economy, is to understand that in order for us to build, to grow, we must have capital. Well, where do we get that capital from? Well, it comes from loans. So we have all of these businesses and all of these individuals who are borrowing money from banks in order to finance expansion of their businesses. And then that's going to generate further economic growth. They're paying off the loan, they're paying off the interest, but because of the production of say, the new facility, they're able to hire more workers. And so that generates growth within the economy. So loans are an important part. Debt is actually an important part of our economic system. What happens, of course, is when we get too far into debt and we're not paying it off, then we begin to see the issues.